Hey everyone, I'm Ella, a finance blogger with over a decade in global capital markets to 5 minutes a day to break down core market logic, help you avoid investment traps, and seize real opportunities. Notice US Treasuries and stocks getting more volatile lately? Institutions are suddenly piling into shorting Treasuries. Even Wall Street is on edge, and it's all tied to Friday's non-farm payrolls NFP report. In today's video, I'll break down 3 key things in plain English: why the NFP report could make or break the Fed's rate cuts for possible pots for US stocks next, and how average investors can position to avoid losses. No fluff. Stay till the end for critical NFP coping strategies, no cuts, just key insights. First, a headline that's shaking Wall Street. JP Morgan's latest client survey released on Wednesday showed that short bets on U.S. Treasuries are surging, hitting their highest level since February. The signal is clear. Institutions are uniformly shorting Treasuries. Betting yields will keep rising. We all know U.S. Treasuries are the bedrock of global financial markets, the core pricing anchor. When shorts pile in, it means capital is gearing up for a major upcoming event, and that event is Friday's August NFP report. You might ask, Ella, the NFP comes out every month. Why is the market reacting so strongly this time? The key is this: the NFP could directly determine how much the Fed cuts rates at its September meeting to 25 basis points or a more aggressive 50 basis points. In short, the next few weeks of U.S. stocks, treasuries, and the dollar will all hinge on this one jobs report. Over the past few weeks, U.S. economic data has weakened repeatedly. Markets originally expected the Fed to turn more dovish, with treasury yields falling. But now institutions are shorting treasuries aggressively. What's the logic here? Do they think the economy isn't that bad? Or are they betting the NFP won't be too weak? Today, I'll break down the NFP's true impact. It's far more complex than it seems. Treasury market logic shifts. Biggest weekly position turns in 5 years. Over the past 6 months, the Treasury market's logic was clear: slowing economy, falling yields, and steady profits for bulls. But in early September, that logic suddenly broke. JP Morgan's survey shows that in the week ending September 2nd, the share of investors shorting treasuries jumped 8 percentage points, the biggest weekly shift in nearly 5 years. Meanwhile, net long positions dropped to their lowest level since February. In other words, bulls who once held onto treasuries are fleeing as fast as they can. The last time we saw such a sharp position shift was in early 2020. At the start of the pandemic. Back then, Treasury yields first crashed, then surged on fiscal stimulus, rewriting the stock market structure for an entire year. Today's shift is already one of the most extreme market signals in 4 years. At this point, you're probably wondering, Ella, institutions aren't stupid. Economic data is weakening. So why are they shorting treasuries aggressively? Aren't they worried the NFP will surprise to the downside, forcing the Fed to cut rates sharply? Don't worry. Next, I'll break down the short's real motive. They're not betting on the data itself, but on a more hidden risk. This asterisk is what the market should fear most. 2 core reasons for surging treasury shorts. Why are institutions suddenly piling into shorting treasuries? 2 key reasons, both pointing to deep-seated market conflicts. 1. Fiscal deficit fears push long-term rate risks higher. Recently, the 30-year Treasury yield nearly hit 5%. The root cause? Market concerns about the Trump administration's fiscal policy, ramping up spending while pushing tax cuts, which will only worsen the fiscal deficit. Investors aren't naive. They're demanding higher yields to compensate for debt risks. And this is the core driver of more short bets. A steepening yield curve signals pessimism. The 2-year Treasury yield, most sensitive to Fed policy, has fallen to its lowest level since May, proof the market is betting on Fed rate cuts. But at the same time, longer-dated yields 10-year, 30-year keep climbing. The result? Short-term rates fall, long-term rates rise, a steepening yield curve. Typically, this pattern means the market is pessimistic about the long-term economic outlook, worried that persistent fiscal pressure will weigh on growth. So, these Treasury shorts aren't just a bet on strong NFP data. They're more about fears of worsening fiscal deficits and rising long-term rates. Short-term yields may fall on rate cut hopes, but long-term yields will be pushed up by fiscal pressure, giving shorts a clear arbitrage window. That's why the Treasury market is in such a contradictory spot. On one side, a weak NFP could force the Fed to cut rates faster. On the other, a growing fiscal gap means long-term rates must keep rising. This mismatch is exactly why shorts are stepping in now. The NFP's make or break levels, determining the Fed's September cut. Why is Friday's NFP so closely watched? Let's start with economists' consensus. August NFP gains are expected to be around 75.0, an already low number. But the real key is this: even a small deviation from expectations will completely shift rate cut bets. If job gains fall below 40,000, markets will immediately price in a 50 point rate cut. As Stephen Englander of Standard Chartered put it, any NFP below 40,000 will be a trigger for surging aggressive rate-cutting expectations. If job gains exceed 130,000 with upward revisions the 50 basis point cut fantasy will vanish entirely. Even the 25 basis point cut expectation will be questioned. In short, this report is nearly the Fed's only reference before its September meeting, no exceptions. Here's a critical note from Ella: don't just fixate on 40,000 or 130K. Even if the NFP hits expectations, moves in the derivatives market could reveal big investors' real moves ahead of time. Want to know how to spot what institutions are hiding in options data? Keep listening. I'll break down this hidden signal next. Subtle divisions in market pricing, surface consensus versus hidden hedges. Right now, the market's rate cut pricing is two-faced. One story on the surface, another behind the scenes. Spot markets the 2-year Treasury yield has fallen to a 4-month low. Traders have almost fully priced in a 25 point cut this month. It seems like a consensus. Derivatives market the SOFR secured overnight financing rate. Options market is unusually active. Massive capital is hedging against the extreme possibility of a 50 point cut, particularly for key expiration dates September 25th, December 25th, March 26th. Options with a strike price near 96, 125 are seeing the most trading. Lots of capital is buying straddles and spreading combinations. What does this mean? The market says a 25 point cut is likely, but it's secretly buying insurance to protect against a weak NFP, forcing the Fed into aggressive action. Put simply, big money isn't confident. They're only surviving by hedging with derivatives. And this division alone shows how fragile the market is. Capital game dynamics, clashes between different types of investors. Data from the U.S. Commodity Futures Trading Commission, CFTC, confirms just how intense this division is. As of the week ending August 26th, hedge funds expanded net short positions in both short-term and long-term Treasury futures. In plain terms, they're betting short-term yields will fall, profiting from rate cut hopes and doubling down on shorts in long-term treasuries, betting on fiscal deficits and supply pressure. Meanwhile, long-term investors like pension funds and insurance companies are piling into long positions, not because they like treasuries, but because their capital nature forces them to hold treasuries. They have no choice. So the market's pattern is clear. Hedge funds are flexible and aggressive, betting on short-term volatility and fiscal deterioration. Long-term investors have no choice but to buy against the trend, passively absorbing volatility. Options traders see volatility as the only certainty, buying insurance frantically. This clash between different capital types has pushed Treasury volatility to extreme levels. Right now, the Treasury market isn't just a bull versus bear fighting, it's capital betting onto entirely different scenarios. If the economy collapses, rate cuts accelerate, and short-term futures soar. If fiscal stability collapses, long-term yields rise, and shorts profits big. The game's core, betting whether the Fed can maintain that dangerous balance. NFP to shape U.S. stocks for possible outlooks. Remember, Treasury yields are the anchor for U.S. stock valuations. Any Treasury market move will eventually hit stocks. Based on different NFP outcomes, U.S. stocks could take four very different paths, and I'll break them down clearly for you. Outlook 1. Extremely weak NFP job gains less than 40,000. If the data is this bad, markets will immediately price in a 50 basis point cut, pushing short-term rates down fast. High growth, high valuation stocks will be the biggest winners, especially AI chips and software, which rely on low rates to support valuations. A rate-cutting expectation drop could trigger a sharp rally. You'll see the Nasdaq outperform the S&P 500, with names like Nvidia and Tesla back in the spotlight. Two under-the-radar areas: high-debt growth stocks, some renewables. Cloud companies, their funding costs are highly rate-sensitive, so a rate drop will quickly boost earnings expectations. And small-cap innovation ETFs, they're volatile normally, but rally harder when rate expectations ease, making them a focal point for short-term rate cut trades. Outlook 2. NFP in line with expectations, job gains 70K 80K. If the data hits forecasts, markets will likely keep pricing in a 25 basis point cut, and U.S. stocks will trade sideways. Money will flood into defensive sectors, healthcare, utilities, consumer staples. When economic uncertainty rises, investors prioritize stable cash flows and dividends. Names like United Health, Johnson & Johnson, and Procter & Gamble may stabilize the market better than volatile tech stocks. 3 niche areas to watch. High dividend telecom infrastructure firms. Their yields attract safe haven money. Healthcare leaders, medical device giants. Generic drug majors. These subsectors have lower volatility and barely depend on the economic cycle. Discount retailers like Walmart and Costco, they benefit from trading down when the economy slows. Outlook 3. Surprisingly strong NFP job gains greater than 130,000 plus upward revisions. If the data is this strong, the 50 basis point cut fantasy will vanish. Even the 25 basis point cut will be questioned. Long-term yields will surge, crushing high valuation sectors, tech, real estate, and discretionary consumer stocks most rate sensitive will get hit first. At the same time, safe havens like gold and silver will reclaim their role as the market's safety valve, and their mining stocks will rise too. Outlook 4. Unexpected winners from a steepening curve. Don't forget financial stocks like banks and insurers. They could benefit here. If long-term yields rise while short-term yields fall due to rate cuts, banks' net interest margins will widen, improving their profit models. In other words, while everyone focuses on tech and gold, financials could be the market's quiet winners. By now, you might be thinking, Ella, these 4 outlooks are complicated. What if I pick the wrong one? Don't worry. Next, I'll share a 3-tier strategy that ensures your portfolio has at least one winning direction. No matter which NFP outlook plays out, keep watching. Hidden risks behind the NFP, fiscal policy, and valuation fragility. Ella's critical reminder: the NFP is just the trigger for market volatility. The real ticking time bombs are 3 deeper risks. They'll linger even after the NFP is released. 1. Fiscal deficit deterioration is inevitable. Why have long-term Treasury yields stayed stubbornly high? The core reason: investors demand higher risk compensation. The Trump administration is ramping up spending and pushing tax cuts. It originally relied on tariff revenue to fill the gap, but last week, a federal court ruled some tariff policies invalid. A worse deficit is all but certain. For Wall Street, this means the U.S. will issue more treasuries in the coming years. More supply equals persistent upward pressure on long-term rates, a problem no single NFP report can fix. 2. Policy uncertainty weakens monetary policy. We've all seen the Trump administration style. It acts without worrying about market impact. Last year, it pushed AI chip restrictions. Now it's trying to use tariffs to fix the deficit. Next, it might even use executive action to influence capital flows. In this environment, even if the Fed cuts rates to stabilize markets, fiscal policy will offset those effects. Monetary policy stabilizer role isn't as strong as it used to be. 3. Fragile U.S. stock valuation structure. U.S. stocks gains over the past 2 years have relied almost entirely on the AI Big 7 and liquid-driven high valuations. The S&P 500's current P/T ratio is over 30x, and the Nasdaq's valuation is near 2000.com bubble levels. In this structure, a sudden yield spike would trigger a faster valuation collapse than anyone expected. Conversely, a surprise yield drop would push capital into high valuation sectors, inflating the bubble further. The NFP is just a spark. The real risks lie ahead. NFP trading strategy, 3-tier planning for all scenarios. After breaking down all this logic, we need to focus on action. I've split pre- and post-NFP positioning into 3 tiers, so you're covered no matter which NFP outlook plays out. 1. Growth tier, tactical position, rate-sensitive growth assets. If the NFP is far weaker than expected, aggressive rate-cutting hopes will push short-term rates down. Focus on high-growth, high-valuation stocks, AI chip and software leaders, plus high-debt renewables, cloud firms, and small-cap innovation ETFs. These assets are most sensitive to rate expectations, perfect for short-term tactical trades. 2. Defensive tier core position, stable cash flow assets. If the NFP is in line with expectations and stocks trading sideways, anchor your core positions in defensive sectors, high dividend telecoms, healthcare niches, medical devices, generics, discount retailers, and leaders in utilities to consumer staples. These assets rely on stable cash flows and dividends, ideal for weathering volatility. 3. Hedge and safety tier protective position, rate shock resistant assets. If the NFP is surprisingly strong and long-term yields surge, shift to safe havens, gold, silver, and their mining stocks. Also consider emerging market ETF CG. Brazil, Vietnam, India, their valuations have less correlation with U.S. Treasury yields, making them potential capital shelters. Add industrial commodities, copper, aluminum, they benefit from rigid global infrastructure demand. Keep this tier small, 10 to 15%. It's your portfolio's insurance. Closing, interaction plus SEO today. We covered everything. The NFP's background for you, stock outlooks, and actionable strategy. The key isn't waiting for the data. It's identifying winning sectors for each scenario ahead of time. If this video clarified the market for you, hit the like and save buttons so you don't lose it later. If you haven't subscribed yet, hit subscribe. I post daily on global financial trends. Next video, how to spot big money moves early using SOFR options data. No more guessing on the NFP. Drop a comment. Do you think the NFP will be weaker than expected, less than 40,000? In line 70K8 okay? Or stronger, greater than 130,000? Which assets will you allocate to growth, defensive, gold? Let's discuss and help each other avoid losses. Finally, don't forget to follow Ella 5 minutes a day to understand global finance and make your investments lose less and earn more.